Listen carefully, because what I'm about to show you changes everything you think you know about global financial stability. If you want to understand the real timeline of the coming economic shift, you need to stop watching aircraft carriers moving through the Taiwan Strait. Military assets are theater. They're designed to be seen, to send signals, to create impressions that may or may not reflect actual intent. They can be deployed for training exercises one day and recalled to port the next. They're the surface level of geopolitics, the part meant for public consumption and strategic messaging. But if you want to know the true intent of a superpower, if you want to understand whether they're actually preparing for an irreversible break with the existing global order, you must look at something far more revealing and far harder to fake: the movement of sovereign debt. Debt is the bedrock of the entire global financial system. It's heavy, it's slow, and it takes months or even years to offload significant positions without triggering a catastrophic market collapse. And when the second largest economy in the world begins dumping the debt of its primary rival at a speed that defies all conventional economic logic, make no mistake, they're not simply rebalancing a portfolio for better returns or adjusting their asset allocation. They're clearing the decks for something far more serious. We need to conduct a forensic deep dive into the data released by the U.S. Treasury Department this week, because buried in those numbers is a story that Wall Street desperately wants you to ignore. The Treasury International Capital Report, the TIC report, is one of the most boring, dense, and absolutely critical documents in all of international finance. Most financial journalists skim the headline number, write a quick summary for their readers, and move on to something more exciting. We're not going to do that. We're going to read the footnotes. We're going to examine what the data actually reveals when you understand what to look for and how to interpret the patterns. What this data confirms is a trend that Wall Street analysts have been trying to dismiss, downplay, or spin away for the last 12 months. China's official holdings of U.S. Treasury bonds have collapsed to $688 billion as of October 2025. Now, to someone unfamiliar with the massive scale of international finance, $688 billion sounds like an absolutely enormous amount of money. And by any normal human standard, it is enormous. But in the specific context of the U.S.-China financial relationship that has defined global economics for decades, this number represents something far more ominous than it initially appears: a catastrophic collapse of financial integration between the world's two largest economies. This current level is the lowest point of Chinese ownership of U.S. debt since May 2009. Think carefully about what that timeline means. We have effectively erased 16 years of financial integration in a remarkably short period of time. To put this in proper perspective, back in 2013, at the absolute peak of what economists affectionately called Chimerica, the symbiotic economic relationship between China and America that seemed unbreakable, Beijing held $1.32 trillion in U.S. debt. They effectively funded a massive portion of the U.S. deficit through their purchases. They bought the bonds that allowed Americans to buy cheap Chinese-manufactured goods, creating a closed loop of capital flow that kept interest rates artificially low and global trade humming along smoothly for everyone involved. That entire elegant system is broken now. China has liquidated nearly 48% of their position from the peak. They have systematically sold off over $600 billion worth of American IOUs. But it isn't just the massive total amount that should alarm any serious observer of global finance. It's the specific market context in which these recent sales occurred that reveals their true strategic intent. Throughout late 2024 and continuing through 2025, the U.S. bond market was experiencing a historic drawdown. Interest rates were extremely volatile, and bond prices, which always move inversely to yields, were significantly depressed below their normal trading ranges. Anyone selling U.S. Treasuries during this specific window was selling at a realized loss. Let that fact sink in for just a moment. In the world of professional asset management, you do not sell a depreciated asset for a substantial loss unless one of two things is happening. Either you're facing an immediate liquidity crisis and desperately need cash right now to pay urgent bills and meet obligations, or you believe the asset is about to become toxic and you're willing to take a smaller loss today to avoid a catastrophic loss tomorrow. We know with absolute certainty that China is not facing a liquidity crisis. Despite their well-documented domestic real estate struggles that have dominated financial headlines, they continue to run a massive trade surplus with the rest of the world. They are swimming in cash from exports. Therefore, the only logical conclusion that fits the data we're seeing is that the Chinese Communist Party has made a calculated strategic decision that the U.S. Treasury bond is no longer a reliable store of value for their national reserves. They view it as a strategic liability, a potential weapon that could be used against them. This is what I call the sanction evasion signal, and we must examine it through the critical lens of February 2022, when Russia invaded Ukraine. The United States and European Union executed a financial maneuver that shocked Beijing to its absolute core. Overnight, with just a few keystrokes and coordinated announcements, they froze $300 billion of the Russian central bank's foreign exchange reserves. These were funds sitting in supposedly secure Western financial institution accounts in New York, London, and Brussels. Russia thought this money was completely safe and untouchable. It wasn't. The entire sum was seized or immobilized instantly. Beijing watched this happen in real time. They analyzed every aspect of the operation, and they realized a terrifying truth that changed their entire strategic calculus. If we make a move on Taiwan, or if the South China Sea conflict escalates into something kinetic, our U.S. Treasury holdings are not an asset we can rely on. They become a hostage. The $688 billion they still hold today is effectively a donation to the U.S. Department of Justice just waiting to happen. The moment sanctions are applied, that money functionally goes to zero. So they're getting out while they still can. They're liquidating the position with what can only be described as extreme prejudice. They are willing to take a 10 or even 20% haircut on the face value of the bonds today, rather than risk a complete 100% loss tomorrow when geopolitical tensions reach a breaking point. This is strategic liquidation in its purest form. It's the financial equivalent of receiving a burn notice. You're cutting all ties before the relationship becomes actively dangerous. They are systematically dismantling what I call the Great Wall of Debt that stabilized the U.S. economy for 20 years. And they are doing it in a way that suggests genuine urgency rather than careful portfolio management. Usually when a major central bank wants to reduce holdings, they try desperately to hide their selling activity to avoid spooking the market and creating panic. They sell slowly in small, digestible chunks spread across months, but the velocity of China's recent drop, shedding nearly $12 billion in October alone, suggests Beijing is far less concerned with maintaining global market stability and far more concerned with getting capital out of U.S. jurisdiction as quickly as physically possible. They want the money out, and they want it out now, regardless of the market impact. This shift has profound implications for the U.S. economy that most people don't fully understand. For 2 full decades, the U.S. government could run absolutely massive deficits without serious consequences, because there was always a price-insensitive buyer in the East willing to absorb the debt. China would buy the bonds regardless of the yield or return because they needed to recycle their enormous trade surplus back into dollar-denominated assets. That reliable buyer is gone now. China has transformed from the biggest buyer into the biggest seller virtually overnight. This creates a massive supply-demand imbalance in the U.S. bond market that has to be resolved somehow. Who is going to buy all the debt that China is actively dumping onto the open market? Who is going to fund the ever-growing U.S. deficit now that the primary buyer has left the building? As we'll see in the next section, the burden is falling directly on the allies, specifically the UK and Europe, who are being forced to essentially cannibalize their own economies to keep the US financial system afloat. When the second largest holder of your sovereign debt decides to dump hundreds of billions of dollars onto the open market all at once, basic economics dictates that the price should crash immediately. When supply floods the market and demand vanishes simultaneously, prices fall. That's fundamental economic law. In the bond world, when prices fall, interest rates and yields skyrocket in the opposite direction. If true market forces were allowed to work naturally, the exit of China should have pushed U.S. 10-year Treasury yields significantly higher than where they currently are. This would be absolutely catastrophic for the U.S. economy on multiple levels. It would cause mortgage rates to explode upward. It would bankrupt regional banks that are heavily exposed to interest rate risk. It would make the interest payments on the national debt completely unsustainable. While the line item for China is plummeting steadily toward $600 billion, other line items are spiking to historically abnormal levels that should raise serious questions. Specifically, look at the United Kingdom and Belgium. The United Kingdom's holdings of U.S. debt have surged to record highs, reaching over $750 billion in late 2025. This puts the UK essentially neck and neck with China as the second largest foreign creditor to the United States after Japan. Think about that relationship for just a second. The UK economy is roughly 1/6 the size of China's entire economy. The UK does not run a massive trade surplus like China did. In fact, Britain runs a substantial trade deficit year after year. So where exactly is Britain getting the money to buy nearly $750 billion of US debt? They aren't buying it with excess profits accumulated from running trade surpluses like China did throughout the 2000s. They are almost certainly buying it with borrowed money or through complex financial engineering mechanisms in the City of London. The UK is effectively leveraging its own national balance sheet to act as a shock absorber for the US Treasury market, absorbing supply that would otherwise crash prices. Then there's Belgium, which presents an even more interesting case study. In the latest data release, Belgium's holdings are roughly $320 to $370 billion. Is the Belgian government suddenly flushed with cash from some economic miracle? Absolutely not. Belgium is home to Euroclear, which is one of the world's largest international central securities depositories. It is literally the plumbing infrastructure of the global financial system. When you see Belgium buying massive amounts of US debt in the TIC report, it is rarely the Belgian government itself making those purchases. It's usually serving as a proxy. It's often other central banks, sovereign wealth funds, or custodial accounts trying to mask their activity and create a layer of anonymity. However, the dramatic surge in Belgium and UK holdings occurring at exactly the same time as China sells suggests something far more coordinated than random market activity. This is what I call the bag holder alliance, a coordinated effort by G7 nations to prevent market collapse. This is not a free market decision driven by rational economic calculation. Why would any rational investor in London or Brussels aggressively buy US Treasuries right now under current conditions? The US is running a $2 trillion deficit. Inflation remains sticky and persistent. The currency has infinite capacity to buy debt because they were effectively the factory floor of the entire world. They earned real dollars by selling real physical goods to real consumers. The UK and Europe simply do not have that same capacity. They are already struggling with their own substantial debt burdens, anemic slow growth, and expensive energy transitions. By forcing them to buy ever more US Treasuries, Washington is actively draining the liquidity from its own allies. It's weakening the periphery nations to desperately save the core. This creates an extremely fragile system vulnerable to shocks. If the UK economy stumbles badly, as we witnessed during the LDI pension crisis in 2022, they might be forced to suddenly sell those treasuries to raise emergency cash for themselves. If that selling begins, the bid of last resort disappears entirely. China understands this dynamic perfectly. China is playing a sophisticated game of financial attrition. They are systematically bleeding the West dry. Every $1 billion of bonds they dump forces the Western financial system to somehow find $1 billion of liquidity to buy it and maintain stability. It draws capital away from productive investments like factories, infrastructure, or research, and into the black hole of refinancing existing U.S. debt. It's a weaponized sell-off specifically designed to exhaust the financial capacity of the G7 alliance before any kinetic conflict even begins. Furthermore, this fundamental shift changes the entire nature of the U.S. bond market in ways that most analysts haven't fully grasped. It used to be a market dominated by economic buyers, China, Saudi Arabia, other nations, who bought primarily for profit and to facilitate trade relationships. Now it's increasingly a market dominated by political buyers, UK, Belgium, Japan, who buy primarily for diplomatic survival and alliance maintenance. Political buyers are inherently fickle. They buy until their own domestic voters revolt against the policy or until their own currency crashes from the strain. We are watching in real time the transition from a global reserve asset that anyone in the world wants to hold to a NATO reserve asset that only allies feel pressured to hold. The market is actively shrinking. The pool of willing buyers is getting smaller month by month while the issuance of new debt continues getting larger. And while the West is busy shuffling paper liabilities among themselves in an increasingly desperate shell game, China is taking the cash proceeds and running directly to the one place the US Treasury cannot possibly touch, the physical world of tangible assets. When China sells a US Treasury bond, the transaction settles in US dollars as required by the system. The People's Bank of China receives a digital credit in a custodial account. But here's the critical problem they're trying to solve. China doesn't want dollars anymore. As we've established, dollars have become a strategic liability. They are traceable through the banking system, sanctionable by Western governments, and subject to inflation that erodes their value. China is systematically exiting the dollar system specifically to escape American financial leverage. So what exactly are they doing with the proceeds of this massive $700 billion exit from US debt? They aren't putting it under a metaphorical mattress. They aren't buying euros, which are essentially US dollar vassals in terms of sanctions risk. And they aren't buying Japanese yen. They are engaging in the most aggressive commodity accumulation drive in modern economic history. They are methodically converting paper claims into physical reality that cannot be frozen or seized. We need to track the cargo ships entering the major ports of Qingdao, Shanghai, and Tianjin to see exactly where this money is flowing. While Western financial analysts stare at bond yields and stock market tickers all day, Chinese state-owned enterprises are swallowing record amounts of raw materials. This is not a normal commercial inventory build to meet manufacturing demand. This is a strategic hoarding campaign with clear geopolitical objectives. First, there's what I call the golden pivot. The People's Bank of China has been a relentless buyer of physical gold. Officially, they have purchased gold for 18 plus consecutive months according to their public statements. Unofficially, the Shanghai Gold Exchange withdrawal data suggests the actual buying is substantially larger than they're admitting publicly. They are using the dollars from the bond sales to buy physical metal on the London and Swiss markets and immediately shipping it east to Chinese vaults. Gold is the ultimate anti-dollar asset. It has absolutely no counterparty risk. It cannot be frozen or seized through the SWIFT banking system. By systematically swapping U.S. debt for gold, China is moving from credit-based reserves that exist only as digital entries to collateral-based reserves consisting of physical metal they control completely. Second, there's the energy lifeline of crude oil. China imports roughly 70% of its oil consumption. This is their strategic Achilles heel that they're acutely aware of. In any serious conflict, the U.S. Navy could blockade the Strait of Malacca and effectively starve the Chinese economy of energy within weeks. To counter this existential vulnerability, China has been buying record amounts of oil, often from sanctioned nations like Iran and Russia at discounted prices. They are paying in yuan or through barter arrangements, completely bypassing the dollar system. But crucially, they are filling their strategic petroleum reserve to absolute capacity. Recent data indicates China's crude stockpiles are nearing 1.5 billion barrels when you combine commercial and strategic capacity. Satellite imagery analysis shows the active construction of massive new storage farms and underground caverns specifically designed to hold oil. They are building a buffer that would theoretically allow them to survive a complete naval blockade for months or perhaps even years. The money for this massive oil accumulation is coming directly from the liquidation of U.S. Treasury assets. Third, there's what I call the metal mountain, copper and other strategic minerals. This is perhaps the most revealing signal of their intentions. China's property sector, which historically was the single biggest consumer of copper for electrical wiring and plumbing, is currently in a severe depression. Real estate construction starts are dramatically down. And yet, China's imports of copper ore and concentrate remain near all-time record highs, with roughly 28 million tons imported in 2024 alone. This defies all standard economic logic. If you aren't actively building apartments and office buildings, why do you need so much copper? Because you're systematically shifting to a war economy? You need massive amounts of copper for the green energy grid infrastructure to reduce reliance on imported oil. You need copper for munitions manufacturing. You need copper for military drones and electric vehicles. China is deliberately cornering the global market on the physical inputs required for the 21st century military-industrial complex. They are also aggressively hoarding cobalt, lithium, and rare earth elements. While the U.S. increasingly financializes its economy and focuses on services and technology, China is materializing its savings into tangible assets. Fourth, there's the food security fortress they're building. China produces roughly 20% of the world's total GDP, but has only 7% of the world's arable farmland. This is another critical vulnerability they're working to address. In response, China has accumulated absolutely massive stockpiles of grain. According to the U.S. Department of Agriculture, China currently holds approximately 60 to 70% of the world's entire global reserves of corn and wheat. They have enough grain stockpiled to feed their entire population for over a year without a single import shipment arriving. They are deliberately trading yield and interest on bonds for calories and survival. This represents a fundamental shift in strategic mindset that signals their true intentions. A nation that genuinely plans to remain at peace keeps its wealth in efficient, interest-bearing financial instruments like U.S. Treasuries. It chases the highest possible return on investment. A nation that is actively preparing for a potential conflict systematically converts its wealth into inefficient physical stockpiles. Holding 500 million tons of copper pays absolutely no interest. In fact, it costs significant money to properly store and secure. It has a negative yield in financial terms, but it has a massive return on survival in strategic terms. China is willingly accepting a lower financial return today to ensure they cannot be economically strangled tomorrow. This explains perfectly why they're taking losses on the bond sales. Western economists mock China's strategy. They sold at the bottom, the analysts laugh. They realized a loss of billions of dollars. This is entirely short-term thinking that misses the strategic picture. Beijing doesn't care about a mark-to-market loss measured in fiat currency terms. They care about resource security and strategic independence. If they sell a bond at an 80% loss, but use those proceeds to buy oil that they will desperately need if the Strait of Malacca gets closed in a conflict, that is objectively a winning trade from their perspective. They are trading what they view as fake wealth that can be frozen or inflated away for real wealth that can be burned in an engine or fired from a barrel. The liquidation of U.S. Treasuries is simply the funding mechanism for this massive strategic stockpile. They are using the proceeds from the old system to build the bunker for the new system they see coming. We have analyzed the capital flows carefully. The data is crystal clear. The trend is completely undeniable. China is selling. The Allies are absorbing the blow with borrowed money they don't really have. The proceeds are being funneled systematically into hard assets that can survive global disruption. The conclusion is both simple and terrifying for the average investor who hasn't been paying attention. The U.S. Treasury bond has become a battlefield in a larger economic conflict. For 40 years, the classic 60-40 portfolio, 60% stocks, 40% bonds, was considered the gold standard of prudent investing. Bonds were the safe haven asset. They were the ballast that kept your financial ship steady through storms. That entire era is over now. The U.S. Treasury bond is no longer a truly risk-free asset as it was traditionally understood. It is a political football in a global economic conflict. It is an asset class that relies entirely on the kindness of strangers who are increasingly becoming adversaries rather than partners. If China, the ultimate insider of the global manufacturing world with perfect information about trade flows, is getting out of U.S. debt, you need to ask yourself a very serious question. Why are you staying in? So how do you position yourself strategically for a world where the biggest buyer has permanently left the market? You follow what I call the protocol. Protocol Rule 1, shorten your duration immediately. If you currently hold bonds in your portfolio, you absolutely must understand duration risk. Duration is a precise measure of how sensitive a bond's price is to changes in interest rates. Long-term bonds, 20-year or 30-year treasuries, have extremely high duration. If interest rates rise by just 1%, the price of a 30-year bond can crash by 20% or more. As China continues exiting their positions, the structural pressure on long-term rates is clearly upward. Even if the Federal Reserve cuts short-term rates to stimulate the economy, the long end of the yield curve, which is determined by supply and demand rather than Fed policy, remains vulnerable to what's called a buyer strike. If China sells and the UK eventually taps out from exhaustion, yields must rise significantly to attract new buyers. Rising yields mean crashing prices for existing bondholders who are locked in at lower rates. Therefore, do not hold long-term US government bonds or ETFs like TLT that track long-term treasuries. These are the specific assets most vulnerable to the Chinese sell-off. If you want safety and yield, keep your cash in short-term treasury bills, 1 month to 6 month maturity maximum. Short-term bills have almost zero duration risk. They are far less sensitive to geopolitical dumping because they mature quickly. They effectively act as cash equivalents that you can easily roll over. Be like China in your personal strategy. Get liquid, get short-term. Don't lock your money up for 30 years with a government that is actively fighting an economic conflict. Protocol Rule 2. Follow the smart money into commodities. China is systematically selling paper assets to buy tangible stuff. You should seriously consider doing the same with at least a portion of your portfolio. Your investment allocation needs meaningful exposure to energy, metals, and real physical assets. This is not just about seeking profit, it's fundamentally about inflation protection and preserving purchasing power. Think carefully about the endgame scenario here. If China dumps their remaining $688 billion and the Allies eventually stop buying due to their own constraints, who ultimately buys all this debt? The Federal Reserve has no choice but to step in. The Fed will be forced to become the buyer of last resort through yield curve control policies. They will have to print trillions of dollars to monetize the debt and prevent a market collapse. When they print trillions of new dollars, the value of each existing dollar falls proportionally, and the price of physical stuff goes up dramatically. This is the inflationary loop that becomes self-reinforcing. China understands this dynamic perfectly. That's precisely why they are buying the physical stuff now before prices rise further. You should seriously consider owning the producers of these strategic assets. If China is hoarding copper, you want to own the mining companies that produce copper. Companies like Freeport-McMoRan or Southern Copper. If China is hoarding oil, you want to own the energy producers like ExxonMobil or Chevron. If China is hoarding gold, you want to own the physical metal itself. These assets act as a hedge against the systematic debasement of fiat currency. You want to own the stuff itself, not just the currency that buys the stuff. Protocol Rule 3. Watch the allies closely for warning signals. You need a clear early warning system. You need to know exactly when the bagholder alliance is beginning to break down. Monitor the currencies of key U.S. allies very carefully, specifically the British pound and the Japanese yen. These countries are straining their own financial resources to support the dollar bond market. Japan, in particular, is the single largest holder of U.S. debt. But Japan is simultaneously fighting its own currency crisis. The yen has been extremely volatile recently. If Japan is forced to intervene aggressively to save the yen from collapse, they will have no choice but to sell U.S. Treasuries to get the cash needed to buy their own currency in foreign exchange markets. If Japan joins China in selling substantial amounts, it is effectively game over for the low-rate environment. Watch the USD-JPY exchange rate like a hawk. If the yen crashes toward 160 or 170 yen per dollar, or if Japanese government bond yields spike suddenly, it means the bagholder alliance is fracturing. That is the precise moment the U.S. Federal Reserve will be forced to intervene dramatically. That is the moment the policy pivot happens, not because inflation has been beaten, but because the Treasury market itself is fundamentally broken. The $688 billion figure is not just another statistic in a government report that you can ignore. It is a countdown clock ticking toward a major shift. China is methodically, deliberately removing itself from the U.S. financial system, brick by brick. They are clearing the decks for what they see coming. They are willing to take substantial losses today to ensure strategic survival tomorrow. Do not interpret the current relative stability of the market as genuine safety. It is an artificial stability propped up entirely by political pressure and borrowed money. When that temporary prop gives way, the adjustment will be violent and sudden. Get out of long-term debt exposure. Get into hard physical assets. Watch the capital flows carefully. The divorce papers have been filed. We are just waiting for the final settlement. The protocol is now active.